All right, welcome ladies and gentlemen to the webinar today. I'm Julian Klymochko. I'm here to chat about SPACs, specifically how to earn low-risk double-digit returns from trading SPACs. So I'm glad you could join us today. This will be a fairly brief presentation, got a lot of stuff to go through. So if you do have questions, I'll get to them at the end of the presentation. Put them in the chat there, the chat screen. And with no further delay, let's get going through the deck here. Disclaimer, I encourage you all to give this a good read, just on all the various warnings and cautions and risks with this respective strategy. So let's kick things off with the introduction. And the way I like to classify SPACs is if we rewind the clock and go back and look over time, each decade was really characterized by specific new financial innovation, new financial instruments. So if we go back to the 1980s, that's right, the go-go 80s, really the time of the emergence of the leveraged buyout. And what really boosted the leveraged buyout was the invention of the high yield bond or junk bonds. Michael Milken was the main inventor of that specific financial instrument, really exploded in popularity, which continues to this day. So the 1980s were really characterized by the junk bond or the high yield bond. Go to the 1990s, big equity bull market. What we saw was a popularity of mutual funds really explode, and you had star mutual fund managers, which we don't really see anymore. But we had, guys like Peter Lynch, Michael Price, etc. Not sure what's going on with respect to the writing on the screen, but let's just keep going. So in the 90s, you had star managers, and the mutual funds really exploded. Then in the 2000s, complex credit products, CDSs, credit default swaps, CDOs, mortgage-backed securities, etc., really fueled the housing boom, which you had this massive credit boom, and the 2000s were really characterized by that specific product. And in the 2010s, really saw the popularity of the ETFs come into play, and that continues to this day. Fast forward to the 2020s. Jury's still out as we're still early on in the decade, but I believe the 2020s will be the decade of the SPAC. Now, let's talk about, exactly what is a SPAC. Sorry, I'm trying to get rid of the crazy red lines on this. I don't know who did that, but it wasn't me. Anyway, the SPAC stands for Special Purpose Acquisition Company, known as a blank check company. Oh, thank you for taking away the red writing on the screen. All it is, it's a cash-rich shell that raises capital from investors in an initial public offering or an IPO, and they have a set time frame to complete an acquisition or specifically a business combination with a private company. So in essence, what a SPAC does, or a blank check company does, is it serves as a vehicle or a conduit to bring a private company public. Now, SPAC terms are fairly standardized. The characteristics of your typical SPAC, they issue units at $10 per unit. Notice that I said units, not shares, because units are typically consisting of one common share and a fraction of a warrant. It can be anywhere from 1/6 of a warrant to a whole warrant, but most often we see a unit consist of a share and either 1/3 or 1/2 of a warrant. That warrant is always struck at a 15% premium to the common share price, so at $11.50 per share. Units tend to split into common shares and warrants up to 52 days. And this is a really important feature of a special purpose acquisition company is the capital that they raise, call it a $200 million IPO, 100% of that goes into trust. And that trust can only invest in low risk T-bills, US T-bills. So the safest asset on the planet, 100% of the IPO proceeds goes into that and cannot be spent aside from a business combination, and they can pay tax on the interest earned, whatever little interest that is, from US Treasuries. Now, two key features in the life of a special purpose acquisition company. As I stated, they generally have a limited amount of time to do a deal, usually 24 months, but can be as quick as 12 to 18 months. But at the end of that deadline, if they don't extend the deadline, they have to liquidate and pay shareholders their cash back. So that's, in this example, $10 plus accrued interest. In the liquidation scenario, which is pretty rare these days, your warrants will be worthless and you'll just get effectively the return of treasury bills. In addition, if they do announce a deal, they put it up for a shareholder vote, and concurrently, or 2 days prior to the shareholder vote, shareholders get the option to redeem their shares for the $10 plus accrued interest. So those are two key features of the SPAC that make it appealing to investors. So SPACs have fairly standardized terms, and as of this morning, I believe there are about 310 SPACs in the market. Just had a ton of IPOs lately, Blake, just crazy. Well, SPACs as an asset class, as you can see, they used to be very niche when I first started following them in 2013. When I built my first SPAC model, there were probably about a half dozen companies in it at the time. Contrast that to now over 300 in our model. So certainly exploded in popularity these days. So this data on the right is per RBC. It was updated as of the end of November. We finished 2020 off at about 82 billion in cumulative capital raised for SPAC. So just a massive boom starting in summer of 2020. If we look here at the monthly inflows, between 2019 and spring 2020, flows were kind of in the 500 million to 3 billion per month range, averaging kind of 1 to 2. And then once summer hit, it just exploded to north of 10 billion per month, which culminated in a massive boom in October. You had about 18 billion. December was crazy too. I believe December was around the 12 to 13 billion range. And January is off to just a crazy start, not even halfway through. As of today, about 11 billion has been raised across just a ton of SPAC issuance. Rewinding back to spring 2020, the entire SPAC asset class was 25 billion, and it now stands at around 140 billion. I just updated these stats last night, but the market just changes so quickly. We had a few more IPOs today and a ton more tomorrow. So we'll crack that 150 billion asset class mark shortly, at least by end of this week or next week. So many people ask, what's up with SPACs? What is the purpose of this strange new asset class? Well, in essence, a SPAC presents a vehicle for a private company to go public. So traditionally, if you are a private company and you're thinking about going public, there's always been the initial public offering. It's been how Amazon went public, Facebook, Microsoft, and you get all these high-profile companies as they grow. Their early backers want liquidity, and they want to raise growth capital from the public markets. And that's really what public markets were created for, was raising capital for growth companies. However, with the growth of, or just the emergence of private markets over the past 2 decades, specifically private equity and venture capital, they've effectively turned the IPO process into a liquidity mechanism or an exit strategy, such that I'd say the majority of IPOs these days are not growth businesses looking to raise capital to fund their growth. These are exit opportunities for venture capitalists, private equity firms, and early backers. Because if you take like Uber and Lyft, for example, basically all their growth came in the private market. And when there was effectively limited growth opportunities left, the backers chose to take it public and seek liquidity to public market investors. Then there's another method, which is direct listing, rarely used outside of post reorganization bankrupt equities. You have seen high-profile firms such as Spotify, Slack go public via direct listing, but it's a really niche process because typically you can't raise capital around that. However, that has changed recently, but we haven't really seen many companies pursue that path. You really need to have a well-known brand in the market to pursue that type of listing. And the third way is through the blank check companies. So we're seeing an increasing amount of private companies go public via the SPAC. It used to be super niche, but you've had a lot of high-profile companies go public via SPAC. One that was recently announced, large brand name company SoFi going public through IPOE, which is one of Chamath Palihapitiya's special purpose acquisition companies, Social Capital, Sophia, I believe, number 4. He has half dozen of these things, so I somewhat get them confused. But nonetheless, SPACs have emerged as a legitimate alternative for a private company to go public. And I am going to go over, some of the key differentiators of why a private company would choose a blank check as opposed to traditional IPO. But first, we're going to chat about, why would a sponsor pursue a SPAC, like an entrepreneur or a management team? What convinces them to want to issue a SPAC? Well, first off, this so-called promote, and by promote, I mean effectively free shares issued to the sponsor to the tune of upwards of 20% of the pro forma SPAC. So if a SPAC does a $200 million IPO, the sponsor could be issued as much as $50 million worth of stock, which is significant. Who wouldn't want that payday for putting up $25,000 to get those Class B or C shares, 1/5 of the SPAC deal? But I mean, it's not only $25,000, substantial amount of work goes into that. In addition, the SPAC sponsor must put up what we call at-risk capital, generally in the form of private placement warrants, because as you remember, the SPAC IPO proceeds goes into trust and the sponsor cannot touch those funds until they complete a business combination or liquidate. So in order to pay the bankers' fees, pay the lawyers, pay advisors, and fund the working capital of the blank check company, they need money. And the way they get that working capital is by putting up this at-risk capital, which is generally 2 to 4% of the IPO proceeds. And they generally do that in the form of private placement warrants. So in this $200 million SPAC example, in addition to the $25,000 the sponsor puts up for the 20% promote, they would also put up, call it, $6 to $8 million of at-risk capital that is generally in the form of private placement warrants. So obviously, a very lucrative endeavor if a sponsor finds success in a business combination, which is why you're seeing many firms turn this into a somewhat manufacturing operation. TPG, Apollo, Oaktree, Social Capital, etc. A lot of brand name firms coming and doing additional offerings. And you're seeing new firms jump into the SPAC space all the time, whether it be SoftBank, which issued SVF SPAC last week. We have Thoma Bravo, a high-profile private equity firm, I believe pricing tonight to launch theirs tomorrow, and John Malone's Liberty Media, their SPAC should be coming out soon. So it's super exciting space. You're seeing more and more high-profile sponsors come into it, and it's not surprising if we look at the lucrative promote available to sponsors. So we looked at the supply side, why we've had this boom in SPACs, but now, it's really two-pronged, because you had this sponsor promote and this acceptance of it as like this new asset class. So sponsors are really pursuing that, monetizing their reputations and networks to earn tens of millions, hundreds of millions of dollars, or perhaps even billions of dollars on some of these big ones. But why do investors like this? So there's been a massive change in the capital markets that occurred over the past year or so. Traditionally, people viewed public markets as short-term focused on quarterly earnings per share, quarterly growth, and that was it. Like, there was the common misconception that people viewed public markets as not willing to invest in companies that may not earn profit or even revenue far out. And so those companies typically stayed private for longer and longer because there's sufficient capital within the private markets. But what we saw, and I think the first deal that kind of proved this out, which was Virgin Galactic, not going to earn material revenue for a number of years out. And investors went nuts for this. People didn't realize, but there's this massive inherent demand for late stage growth opportunities when they're in the sort of Series D/E VC rounds. Typically, when they'd be pursuing that, it's been revealed that public market investors, many retail investors, and even institutions, mutual funds, etc., There's tremendous demand for these types of late-stage VC growth opportunities that are not only pre-profit, but some of them are pre-revenue, such that they're not earning any material revenue until 2025, 2026, sometimes north of 5 years out to earn revenue. And investors are clamoring to get into these. If we look at Velodyne Lidar, Hyliion, Lordstown, Quantum State, ChargePoint, I believe QS, their stock post-SPAC deal closing, it actually went up above $100 per share. And this is on a $10 SPAC. So it really shows the exceptional demand that a certain contingent of the market has for these types of opportunities. So what really created this SPAC boom ever since the summer was a confluence of these two factors. On the supply side, a lot of sponsors recognizing the tremendous economics of launching a successful SPAC. And on the demand side, investors realizing the opportunity in these late stage VC type opportunities, which they never really had before because those companies have been staying private for longer and longer. Investors weren't getting access to like an IPO of Apple or Microsoft or even Amazon when there's a lot of growth left. Those were staying private for 10, 12 years if we look at many of the companies now going public. So that's a really interesting dynamic on the demand side. So why would a private company pursue this when they could stay private or pursue a traditional IPO? Well, there are three main advantages of the SPAC over a traditional IPO. So number one, why they do this instead of seeking funding in the private markets, you can raise way more money to fund growth within a SPAC because we're seeing a lot of them do these PIPE financings concurrently with their going public transaction, and a PIPE financing can be in the hundreds of millions of dollars. It stands for a private investment in a public equity or public entity. And in addition to that, these SPACs have generally hundreds of millions of dollars of cash in trust that they can utilize. So as a private company, you can raise a significantly more capital by going public by a SPAC. But why did pursue this? In addition to the size of capital raise that they can do instead of a traditional IPO, number one is speed. Equity window wide open these days, especially for SPACs, such that companies don't want to risk the 12 to 18 months that typically takes a traditional IPO to go public. Who knows, maybe market conditions change, they got to pull it, they don't want to take that risk. A SPAC can complete a going public transaction of a private company in as little as 3 months. Then another key aspect, when you have a early stage growth opportunity that isn't going to be generating revenue until a few years out in the future, when you go public via traditional IPO, you can only say what's in the S1, and the S1 only talks about historical information. So the private company cannot give guidance, but they can if they go public via SPAC. It's a bit of a regulatory loophole because this transaction is technically a merger. And so the SPAC can give guidance, and you're seeing a lot of them give guidance out to say 2027, saying, oh, 2027, we're going to be earning $5 billion in revenue, $1 billion in EBITDA. This is why you should buy the stock. And that really sells the story these days. And lastly, certainty in terms of valuation. If you look at the Affirm IPO, it gets priced the night before, and the company really doesn't know much regarding valuation of the offering. But within a SPAC, they're just negotiating with the sponsor team, and they get much more insight and certainty into their valuation. So recent SPAC performance, if we look at the orange line, has been pretty substantial. Lots of business combinations being announced, a so-called SPAC pop, which we're going to get into upon deal announcement, and used to be able to generate, great low-risk yields from Spec Arbitrage, which is getting trickier and trickier these days with the recent booms as yields, SPAC yields or arbitrage yields within the SPAC space, meaning SPACs that are trading at a discount to the cash value are really non-existent these days with the recent rally in prices. Then on the IPO side, this is where we've been hunting for deals lately, just because everything's trading up to a premium. And if you look at all these recent IPOs from as recently as yesterday, I believe all the ones yesterday were trading at a 7.4% premium to the $10 issuance price. So guys like us, we did subscribe to 3 SPAC IPOs yesterday, and it's no surprise there's this absolutely ravenous demand for these. Basically, every deal is 5 to 10 times oversubscribed, just because people are getting used to these IPOs going up significantly on the first day. So it's gotten increasingly competitive, which was significantly different than how things were just in November. So what we do, we like to do Spac Arbitrage. And the way that Spac Arbitrage works is there's really two return drivers, yield and optionality, of which both those characteristics are made up of two individual drivers. So on the yield side, say you buy it, a Spac at $10, well, you know that the cash that the Spac owns is going to be generating the yield of T-bills. So you can expect that sort of baseline T-bill return. Although these days it's quite low. Prior to Q1, T-bills were yielding north of 2%, so you could actually earn a decent yield similar to T-bills investing in a SPAC. Then in certain environments, you can actually buy these at a discount to their cash value, not really available these days, but it was as recently as last week. You can generate a higher yield if you're able to buy them at a discount to their NAV. Call it like $9.90, $9.95 per share. In a bear market, you know, these can trade down to $9.50 or $9.70. So have some dry powder on the side. So that keeps track of the, takes care of the yield component. Now, the real torque in the strategy is optionality. So there's this thing we call the SPAC pop, tremendous stock upside optionality on deal announcement, where you're seeing, you know, deals get announced, whether it be what's been a good one, ArcLight announced Proterra the other day, a couple of days ago, and the stock effectively more than doubled overnight. And so there's this tremendous upside optionality on deal announcement, and the market is very, very favorable to new deals being announced in the current environment. Not saying that it'll be like that forever, but it is definitely like that right now. Then lastly, on upside optionality, if you do buy the units, you're effectively getting, like, especially in the IPO, if you buy $10, you get shares at $10 and warrants for free, and those warrants can have significant value. There's many warrants that are now trading north of $5 per share. So if you're able to source those by buying a unit and get the warrants for free, that's always a tremendous deal and gives you more upside as the SPAC matures. So we really like SPAC arbitrage, given these differentiated return drivers, which has been working pretty phenomenally well lately. And this is how arbitrage works on SPAC shares. If we look at the graph on the right, this is VectoIQ, which announced a transaction with Nikola. Rewind back to May 2019 at the start of the chart. The blue line shows the SPAC share price, and the orange line shows the SPAC net asset value, or the cash in trust. And back spring of last year, you could actually buy VectoIQ at a material discount to its net asset value, which was roughly $10.35 at the time, and was, you know, accruing more than 2% per year, just given T-bill yields at the time. And if you could buy the shares at $10, that's like a north of 3% discount plus a 2% T-bill yield. You can expect a baseline return of 5%, excluding any sort of upside optionality. But then, as you can see, when they announced the Nikola transaction, the share price rallied to nearly $15, allowing arbitrageurs to crystallize that tremendous upside optionality, where that 5% baseline return now turned into, you know, 5% plus 50%, which is significant for a deal or an investment that has such low risk, given that inherent redemption feature or liquidation feature at the end of a SPAC's life. It basically gives you a European style put on the stock. Now, this is what we're talking about when we talk about the SPAC pop. All of these SPACs, CIIG merger, Pivotal Investment 2, Longview, they all announced a business combination of which the market viewed very favorably, and they rallied north of 50%, sometimes 100% in certain instances. I believe CIIG actually exceeded $30 at one point. So this just shows the tremendous upside optionality of SPACs in the current environment. But my favorite part about SPACs and special purpose acquisition companies, specifically on the arbitrage side, is that we have this sort of, what's the right word for it? This mechanism, not necessarily rescue, but it's more of like a buffer that protects your downside, this built-in sort of put option that can protect you in a bear market, because at the end of a SPAC's life, if they don't get a deal, they redeem for $10 plus accrued interest. Or if they announce a deal, you don't like it, or if it's a bear market and it trades down, you can redeem for that value. So it's like an inherent put option that protects your downside, which we really like, because if you look at the SPAC pop plus this inherent redemption mechanism, it really presents equity upside with the risk profile of T-bills. So we like to arbitrage the units these days, try to buy the SPAC units at or below NAV, which in the current environment is only available at the initial public offering, and hold them until deal announcement of the SPAC deals announced currently. Time between IPO and deal announcement is, or averaged, 319 days. So about 10 months from IPO to average deal announcement. They can happen super fast. I've seen some happen within the first month. I've seen some happen in like after 2 years, after they extend it a number of times. And then, it's tremendous optionality in these. Of the 50 SPACs that have announced a business combination currently, they trade at an average premium to NAV on the unit side of 66.4%. Imagine buying at $10, and on average, after a deal announcement, they trade to $16.64. So that's a pretty tremendous stat and supportive of the strategy. So when they announce this business combination and you do see this uplift, you recognize that investment gain from the upside optionality on the shares and the increase in value of the warrants. So got to caution some investors. I mean, it's pretty difficult strategy, and there's a lot of nuances. I always say it's simple but not easy, and one thing to be aware of is post-SPAC equity trading dynamics. So when I talk about post-SPAC equities, I'm talking about a different asset class. So a SPAC IPO is at $10, units splits into shares and warrants, and then announce a deal. Then they offer a vote in which investors can redeem. Now, post-vote, I consider that security no longer to be a SPAC. It is now a post-SPAC equity because investors have lost their downside protection through that redemption mechanism. So now, after they do the vote, it's now post-SPAC equity, and post-SPAC equity has no downside protection. At $10 per share, it can effectively trade wherever, and these are, significantly like very volatile stocks. So keep that in mind. And some of them perform poorly. I mean, there's studies online that show post-SPAC equity performance. They've been great lately on an average basis, but not so great on a median basis, because you have a number of huge winners. It follows somewhat of a Pareto distribution. You look at it like a DraftKings and the big winners like that, QuantumScape, etc. They drive the average up, but note that there's a lot of losers that trade down to, $5, $7, even $2 per share. So keep that in mind. You want to be well diversified if you're holding a basket of these. And post-SPAC equities have a spotty track record. In our arbitrage strategy, we always make sure to exit by the vote, such that we maintain exposure to SPACs and no exposure to post-SPAC equities. Now, this is a key aspect of the strategy. It's keeping track of all the key dates and all the key materials. So you certainly need a complex modeling out all SPACs that you own, all 310 SPACs, what the current net asset value is. Should you redeem? What are the key redemption dates? Because I've even had many individual investors reaching out, even institutional investors being like, hey, I thought this SPAC was low risk. Why am I down 20% today and it's trading at $8? I'm like, well, you missed the redemption date, and there's nothing you can do about it now. So I say the strategy is simple, not easy. It requires a full team monitoring these, working long days, subscribing to IPOs, monitoring trading, monitoring all the key dates, the net asset values, trust values, etc., and certainly keeping track of the deal votes and the redemption dates. So because you don't want to miss those, because then a low risk strategy turns into high risk and big downside. One key aspect is the diversification benefits of SPACs. Many people say, how did these react in Q1 of 2020, which was the most volatile market environment in history? The VIX, during the depths of the pandemic, the VIX hit 85, which exceeded even the 08-09 financial crisis, which was another fun time I was investing through. But nonetheless, if we look at the performance of our Accelerate SPAC Index, the blue line, versus the Global Bond Index, the orange line, the Bloomberg Barclays Global Aggregate, if we compare those two, supposedly safe bonds, Over the first 5 months of 2020, they returned 2.1% with a volatility of 7.7% and a peak drawdown of nearly 9%. Compare that to our SPAC index or Accelerate SPAC index. Well, by April, SPACs were hitting new all-time highs. The SPAC index returned nearly 4% in the first 5 months of 2020 with a volatility of 5.3%, so 31% less volatility than bonds and a peak drawdown of just 6.6%, so 25% lower peak drawdown. So it really just goes to show you that SPACs were a good place to be throughout the Q1 pandemic, which was, as we all know, the most volatile moment in market history and the quickest bear market in market history. And I should point out that over the first 5 months of 2020, that SPAC index actually had a negative correlation with traditional asset classes such as stocks and bonds. So I always say the only free lunch in investing is diversification. And by diversification, we mean uncorrelated return streams. And I believe that's what we can get out of a diversified portfolio of SPACs. So some really interesting stats with respect to special purpose acquisition companies. Their performance really held up when you needed it in the most volatile market environment of all time. And one other dynamic I wanted to go over in this presentation is, SPACs are a very peculiar security. Like there's really no inherent investor that would buy it. For example, growth investors, it's not a fit because there's no revenue growth. There's no story behind it, right? Then value investors wouldn't buy it because there's no cash flow to look cheap upon. Quality investors, I mean, there's no, business metrics to really judge this type of security on. And then index and ETFs, they can't buy them because there's really no business in it. But one contingent that has gravitated towards SPACs has been risk arbitragers like myself. So it's very similar to merger arbitrage. I cut my teeth over a dozen years ago trading closed-end fund arbitrage. And, that's why I gravitated towards SPACs in 2013, just because it was very similar to closed-end fund arbitrage. So on these SPAC IPOs, you see a lot of hedge funds subscribing to the SPACs. And us hedge funds, we view ourselves as bridge lenders, effectively. We are renting out our capital to a sponsor team such that they can go in search of a business combination and have the opportunity to earn that 20% promote, which presents an exceptional compensation scheme for themselves. As hedge funds, yes, we get compensated well by buying these SPACs at $10 per unit and seeing the uplift upon deal announcement. And there's this sort of circle of life where hedge funds come in, subscribe to the IPO, act as bridge lenders for the SPAC sponsor until they find a business combination. Once they announce and market a business combination, you have retail traders get excited about it. They cycle in, hedge funds cycle out, recycle their capital into new IPOs. And then once the deal closes, you see a lot of pickup from mutual funds and these theme-based ETFs. It's a gambling deal within the SPAC space. You start to see gambling themed ETFs pick it up post-closing. So that's a circle of life that sponsors and investors definitely need to be aware of. Now, how to access SPACs. So I actually launched the first SPAC-focused ETF in the market. We launched it last April. Long been a fan of the sector, been running this arbitrage strategy since 2012. And it's performed phenomenally well. We kind of lucked out with our timing. Probably won't see it as good as we've seen it, but just due to the characteristics that I've discussed in this presentation, low correlation, upside optionality, downside protection, I really like it as a strategy, and that's why we run the Accelerate Arbitrage Fund, which trades on the Toronto Stock Exchange under ticker ARB. We always buy at or below NAV. I believe it's the only ETF that provides investors access to SPAC IPOs. We got 3 IPOs today. We got in the SoftBank one last week, so got great deal flow and super excited to back some of these awesome sponsor teams and see what type of companies they bring public. We were shareholders, for example, in the ArcLight deal. We bought that upon IPO, and now they announced a deal with Proterra, which was just looking to be a huge winner. So we currently hold a well-diversified portfolio of over 150 SPACs, and we think that we are the specialists in the space and offering the most pure play in the sector, and we never hold post-vote, so we always are holding pure play SPACs. And I'll wrap things up, get to some questions today. So to go over some key aspects of this presentation, SPAC, certainly a growing asset class. They've gone from about 20 billion in market capitalization 1 year ago to now almost 140 billion. So it's not often you see an asset class grow by 7-fold in 1 year. So it's worthwhile having on your radar. When we launched the Accelerate Arbitrage Fund, we certainly didn't foresee this massive boom, and so sort of lucked out in our timing. However, always been a big fan of the return potential and the phenomenal risk reward dynamics of the strategy. And that's really why we launched it. So for arbitrageurs, it offers a great baseline yield with attractive upside optionality and downside protection, which is super important for sponsors, a tremendous upside return on capital, lucrative sponsor promote opportunity. And then for investors, it offers a new uncorrelated asset class, and it's not often when you see new asset classes come along to diversify your portfolio with uncorrelated return streams. So I think that's super powerful and one of the main reasons that investors need to pay attention to this asset class. And so it's got a lot of unique and attractive characteristics. That's why I'm a big fan of Spac Arbitrage and blank check companies in general as an asset class, and follow it super closely. I've invested in probably over 200 SPACs, and certainly follow every single deal out there. Happy to answer any questions that you got. We will be posting this webinar on our website, accelerateshares.com. Feel free to reach out. There's my contact information, or you can go to our website, accelerateshares.com, book a meeting with me. Yeah, I mean, that's pretty much it for now. I will get to questions here. Looks like the chat was fairly busy. So one from YCHAM, he says, when you buy the unit, okay, sorry about that. My chat just got a bit messed up. I just got to make it a bit bigger here. So when you buy the unit version of the SPAC and it converts to the commons warrant, do you automatically get the conversion? No, so typically you need to go to your broker and split the units to shares and warrants yourself. I have seen one or two automatically split, but this is unorthodox. You typically need to split yourself. How do you personally value the warrant? So we never buy warrants. We just get them for free through the units. But if you are trading warrants, be aware that the vast majority have anti-dilution provisions that actually lowers the intrinsic value. So read the S1, the prospectus, to figure out the exact terms of the warrants. Some are redeemable when the stock's over 18. Some are redeemable when the stock's over 10. Most of the time, they have anti-dilution provisions, which limits the conversion to 0.361 of a common share. So keep that in mind for sure, and the redemption provisions. Okay. Someone notes that it can cost money to split units, but Fidelity does it for free. What else do we got here? What do you think of a specific SPAC? I'm not really going to talk about specific SPACs on the webinar today. Don't really have time for that, but definitely do your due diligence. Go onto Edgar and read all the materials on there. Certainly, I encourage you to do that. Looking for more actual questions here. He says, is there any way or platform where we can buy ARB ETF in the USA? Unfortunately for retail investors, most don't allow it, which is frustrating for us. Obviously, we want to welcome all investors. So institutions can do it through their prime broker. And if anyone figures out a way for the average investor to get access to it, definitely email me, because I want investors to be able to access it and trade it. So I'd be certainly interested in that information. Oh, someone did say you can buy it on Fidelity. If that is true, okay, yeah, I have more confirmations. So that's awesome. Praise Fidelity. They are the best in my opinion. Oh wait, no, maybe that's the. Be aware that in the U.S. there's another one with the same ticker, the Alt Shares Fund. That is not us. It's not the Alt Shares Fund. Okay, expense ratio, the ETF, 0.95% management fee, no performance fee. And sorry, I'm trying to read the questions, but it resets each time someone types something in. So are SPACs IPOing higher than $10? No, they still IPO at $10, but they all have been trading above $10 once they hit the market these days. In this environment, not guaranteed to be that way always. So there are some that IPO'd at prices not $10. So PSTH did do theirs at 20, and also ENPC did theirs, I believe, at $25. So that's something to keep in mind as well. The warrants give you the right to buy common shares of the new business. Yes, typically these are exercised in a cashless way. Or SPACs now IPOing above $10? Nope. So we do hold warrants post-closing. They're a small portion of the portfolio, and we effectively do get them for free by buying the warrants. So it's just like additional upside optionality, and it's they account for about 2% of our total portfolio. We're the best SPAC investors to follow on Twitter other than yourself. Oh man, there's so many. And some of them have a ton of followers. So just do some exploring, and you'll find them. They get retweeted a lot. So there's too many to mention. I'm always retweeting guys in my feed. So check out mine, and I'll lead you to more. When does the RBTF sell the SPACs? Okay, so we have a systematic selling process. Deal gets announced. Our units will be split into common shares and warrants. And typically between definitive agreement signing, and they announce it, and deal closing, averages 3 months. So we have a basket where we're selling all the post-announced SPAC equities or post-announced SPACs that haven't closed yet. And we basically sell them over the next 3 months, trying to capture the average premium. What are the red flags when evaluating SPAC that is IPO and deciding whether ARB will put in for an allocation? There's a number. You look at the sponsor reputation. You look at the amount of capital, their ability to raise. We typically stay away from the smaller ones, like more illiquid, sub $100 million. Not super keen on the international ones. You look at warrant coverage and all the terms offered to investors, the underwriters as well. And we do read through the S1 to see if there's any potential red flags, make sure that the redemption feature is solid, liquidation, time frame, just to make sure there's no potential red flags and pitfalls. Will you sell a SPAC prior to LOI if it trades at a huge premium? No, I mean, we're pretty consistent and systematic in our approach, is that we wait to a definitive agreement on a deal that's highly likely to close, and then we put it in our systematic selling program, which typically takes 3 months. If PSTH decided to start in at $20, don't you think we will see new SPACs doing the same? No, I mean, that trend hasn't caught on. For guys like me and other hedge funds, it's kind of annoying because we're used to things being standardized in our models. So personally, I prefer standardized terms at $10. So we did see PSTH at the $20, and then we saw ENPC as well. As for others really following it, we did see Parafas Capital Partnering Corp, PCPC, do a $25 deal. But I believe it's just been those three that haven't gone with the $10 structure. Yeah, those are the only three that I know of. So investors, it just really shows that trend isn't really catching on. Sometimes sponsors do give an overfunded treasury in which the SPAC will start out with a NAV of 1010, 1015, 1020, or even 1025. So that's a nice bump for investors. We always like to see that. Okay, when are you launching your own SPAC? I actually have a capital pool up in Canada, Red River Capital. It's trades on the venture, currently halted. We do have a definitive deal with Bitcoin Well, so hopefully we can close that soon. As for a US SPAC, no plans in the near term. How can you get an allocation for SPAC IPO? So you need good relations with the underwriters. There's really probably 15 key underwriters in the space. Got to have good relations with all of them. You obviously got to have a lot of money, so it's not really available to average investors. So that's what we try to provide in the fund. So you really got to be a fund or a family office, or have probably north of $10 million yourself. just to get that deal flow because you need to compensate underwriters. Makes sense to basically buy as much SPACs as possible for price around NAV, and eventually they'll rise. I mean, we like the diversified approach because, yeah, you can look at sponsor, you look at mandate, but some of the most low-key sponsors have announced the best deals, and some really good deals come from sponsors that have pivoted their mandate. Like, we've owned a number of SPACs that had a mandate in real estate, and then they pivot to like electric vehicles, such as what they did Diamond Peak and Lordstown. That one was a massive winner, and if people paid attention to the mandate or the sponsor reputation, then they missed that. So we like the diversified approach, such that we can have a highly diversified portfolio, like I said, over 150, which is really impossible for a retail investor to have in their portfolio or even keep up on, because it's a ton of work. But we think a diversified approach is best, but there's no right or wrong way to do it. Perhaps others find success utilizing other methods of trading in this asset class. How credible are articles from Bloomberg or Reuters about deals? It really depends on the author. Typically, Bloomberg and Reuters are very credible sources. So definitely put some, we never buy off rumors. We refer to that as rumorage. However, it's worthwhile paying attention to. Typically, Bloomberg and Reuters are right. However, it's not guaranteed. Do you mean diversify between sectors or sponsor management teams? I mean, just it's rare that a sponsor management team has so many pre-deal SPACs in the market. You have seen it from, say, Churchill Capital and Social Capital. They'll have perhaps 3. So it's really hard to get, just focus on 1 or 2 management teams. And the sectors, many are diversified. So it's hard to really focus on a specific mandate and sector when they're constantly changing, right? Okay, rumor, AI is in talks with CF Finance acquisition. Okay, thanks for telling that. Trying to go through some more questions here. For retail investors, do you recommend to buy units or stocks? It's really personal preference, and I can't really recommend one or the other. Just pay attention to price, and I believe it was Ben Graham who said price is what you pay, value is what you get. So it depends if you want to hold units and split them and then hold shares and warrants, or you just want to hold common shares. Each one has pros and cons. Do you think there's a correlation between size of the offering, 200 million versus 500 million in the target company growth phase? That's a good question. I think there is, because generally a SPAC will target a company 3 to 5 times their IPO rate. So 200 million, they're targeting companies with equity value about 600 million to $1 billion. Meanwhile, 500 billion, you're playing in the sandbox of 1.5 to 3 billion, right? And so those are different types of companies, and it really depends. Certainly, a company at 600 million will have a dramatically different profile than one valued at 3 billion. Any comments on SPCX? No, not commenting on individual SPACs, just because then we'd be on this all day. Okay, recording be available for this meeting yet? Go to accelerateshares.com. We'll put it in the events section. Is there any potential for fraud with SPACs such that they use money that's supposed to be held in trust? That's a really good question. So I've seen one instance in which a sponsor put the capital into an investment that wasn't US T-bills, and it actually went down, and they got caught by the audit committee, and the sponsor was forced to basically put in more capital to make up those losses. So that is a good question. Which SPAC will pop next? I say stay tuned. No one knows, even me. Any calendar where we can check the SPAC IPO for the current day? Not exactly sure what that means, but we keep an event calendar, and I try to tweet it out every weekend. So yeah, pay attention to my Twitter feed on that one. Interesting to see Oaktree's first SPAC trading at 70% premium to NAV, whereas second SPAC is only 5% premium. Yeah, we like to see those inefficiencies. That's actually how we got into Churchill's recent SPAC. Actually bought it at a discount on the day of its IPO, and we saw the relative value differential between its other SPAC issuers in the market. And that's it's just proof that this is an inefficient market, and a place where diligent and enterprising investors can really generate alpha. So it's not very often you find this many inefficiencies in an asset class. It's like large cap growth equities. You can't find massive pricing inefficiencies, but you can in the SPAC market. Will ARB ever hold through merger? No, although we do hold post-SPAC equity warrants just because we get those for free and it's kind of free upside optionality. Oh yeah, ZGYH, that was the one in which they lost money and management team had to go and re-up the trust, put in more of their own capital such that, it's back up at $10. So thank you for mentioning that. More question. Any good source of information? Yeah, I mean, I think Twitter's a good information source. There's a lot of independent research firms now covering this space. Can you expand on correlation of stocks and bonds and how those were measured? Pretty incredible specs. Yeah, I mean, so the correlation, we measured the performance of every SPAC in the universe at the time and versus the S&P 500 and versus the global aggregate bond index. And those are the numbers that we came up with. Yeah, so in terms of exit strategy, we do have a rules-based systematic exit strategy. Deal gets announced, and we'll systematically exit over the next 3 months. So we have a selling program that we're executing every week. There's a basket of SPACs that announced a deal that are in the selling program that we're effectively exiting in a TWAP 3 months from post-deal announcement. Is it possible for SPACs to trade under $10 before redemption date? Oh, certainly. I mean, back in April, we were buying everything well below $10, which was a great time to be investing. But these days, kind of flip the opposite. Everything is trading at a big premium. So not available in the current market, but just, yeah, we put out a monthly SPAC monitor in which you can look at premiums and discounts. And that does change rapidly. So it's worthwhile keeping track of that. Yeah, we'll try to make the slides downloadable on the webinar as well. We'll see if we can do that. Oh, if you go to accelerateshares.com and click on the ARB fund, there's a link to, I believe you may be able to download a bunch of different PDFs and things of that nature. So check there. As I said, in the events section, you can replay the webinar on YouTube. You mentioned risk around warrants outside of no downside protection. You mentioned something around redemption within the S1. Yeah, I meant just pay attention to the warrant provisions, of which there are a lot. Some warrants post-deal can be called if the shares are above $10. Some warrants can be called post-deal if the shares are above $18. Some warrants can be called if the shares are above $16.50. And by called, basically it's forced exercise. And generally, management can force you to do a cashless exercise. And often there's anti-dilution provisions that limit the conversion to 0.361. So it really limits the intrinsic value of those warrants. So read that and be experts into that if you are trading the warrants. What is high returns on average? Buying SPACs with lesser known management teams trading on NAV or buying those that are immediately traded up because big name team? It's real tough and will vary over time. We haven't done that study. I mean, we obviously try to own the high profile ones if possible, and occasionally we get access to it, like the SoftBank one. We did get an allocation in ARB to the Northern Genesis 2 SPAC, which is trading at a massive premium. No wonder, because the first one, NGA, was just such a massive winner off their Lion Electric deal. I mean, those units, oh my God, trading around $40 per share. So we did get those units of the first one, which are around $40. But it's no wonder that the second one was such hot property. How can we see which SPACs your fund currently holds? Okay, go to accelerateshares.com, go to the ARB fund, and we do disclose our holdings on a monthly basis. So we have our holdings as of January 31st. Obviously, these change nearly on a daily basis, just because we're cycling out of some, recycling the capital into new IPOs. And this month, we've probably bought over 10 IPOs already. So that changes pretty dramatically. So keep an eye on our website for updates. We produce a ton of content, and we're constantly updating the ARB page for our new holdings each and every month. Just trying to find more questions here. Oh, can you speak about the attached rights? Yeah, rights are interesting. Most of them function kind of similar to warrants. I have seen some deals that they only give you rights if you hold post-merger. So, I mean, rights are rare, but they come across pretty often, and usually just another incentive for people not to redeem. So it's worthwhile considering that as well. Could be additional compensation for investors. Looking for more questions. Spac market dips below par and you want to redeem your units at par. How long does it take for you to get your cash back? So you can't actually redeem units. You can only redeem shares. So you'll need to split those units into shares plus warrants. And you can only redeem the shares upon 2 days, 2 business days prior to the vote. So it's not like you can exercise it like an American option. There's a specific date. If they announce a deal, if they gave you the vote date, like for example, ACAM, which we hold the day to indicate to your brokers today, if you want to redeem or not redeeming because the shares are trading significantly above net asset value. But how long does it take to get the money back? Our PB does it within a few days. So not too long. Same with these splits as well. So will you be listing on the NYSE, NASDAQ anytime soon? I mean, that is a goal of ours, still early stage, but we have been having conversations with potential strategic partners on US expansion because we do recognize there's a pretty tremendous demand for this strategy, and we want to give it to all investors because we think that it's pretty cool to be able to invest in that. So, you know, US expansion, we're hoping to be able to do that, but really nothing to report at this month, at this time, unfortunately. Any reason why they set caps on redemption trigger price? Really just to limit dilution. You know, and it seems like sponsors are getting away with more and more as demand increases. I believe Thoma Bravo eliminated the warrants, and you see it from many high-profile sponsors. Dragoneer, I believe their latest one had no warrants. A lot of the biotech ones have no warrants, and some of the venture capital sponsors are now eliminating warrants. I saw Liberty Media yesterday for their upcoming SPAC. They reduced the warrant coverage from 1/4 to 1/5. So it's really, you know, how crazy is the market and how much can sponsors push these things like worse and worse terms on investors, like callable at $10. It's not great to see that, but you know, it's kind of the reality that we live in. Terms get looser as the bull market continues. Since you don't hold until the vote, do you think that limit how much you allocated? I mean, I don't think it's, you know, the worst thing. I think what's bad is people flipping on day one. So many fast money hedge funds are coming in and flipping out of the stock in one day, which we never do. I mean, you know, at least we're willing to hold it for 2 years, which is long term these days, and you know, team up with the sponsor to have them get a deal done. But the ones, you know, just fast money, they're not really SPAC focused. They're looking to clip that 5% gain on the first day and then flip it. You can see the tremendous, you know, first day volume on many of these IPOs where they're trading like 10% of the float on the first day of a lot of these fast money hedge funds flipping the stock. So, you know, that's a strategy that we don't do and we are against. And I think those are the, you know, the real short-term money that sponsors want to stay away from. I think I've answered all the questions, and we are coming up to the 1 hour time frame. Oh, so I did see, okay, a couple more questions coming through. To use leverage, yeah, our portfolio is leveraged about 1.3x, so 130%, which we're comfortable in the range of 120 to 150%. We have substantial excess buying power, so we are currently at around 130% gross levered, or 1.3 times. Then you tweet about oversubscribed trusts. Well, a couple things that were confused here. So oversubscribed IPOs means, like, say on a $200 million IPO, there could be $500 million in demand. That's what I mean by oversubscribed. Now, with respect to trust, there's the concept of overfunded trusts, in which the sponsor puts $10.10 per unit into trust, such that you're starting with a NAV of 1010, 1015, even 2025. So two things: oversubscribed IPOs or overfunded trusts. Yeah, so we'll wrap things up here. It's 1 o'clock. You've had an hour. Feel free to reach out to me if you have any additional questions about anything we chatted about. And check out the website, accelerateshows.com. Give a follow on Twitter if you want more coverage. Thank you to everyone for tuning in to the webinar today. Hope you enjoyed it, and best of luck with your security selections. So I'll stop it for now. Hope everyone has a great day. Bye.